Welcome to This Explainer. Today, we're diving into a wild day of Q2 Fintech earnings that honestly looks less like a standard financial report and a whole lot more like a high-stakes sports draft. We're talking about major shifts, surprising plays, and some serious corporate drama. In the fast-paced world of financial technology, things move quickly, but the data we just got from this latest earnings cycle is turning heads all across the industry.
You know, there's a brilliant quote from our source that perfectly captures the theme of today's explainer. Earnings season giveth, earnings season taketh away. Sometimes in the exact same press release. It perfectly sets the stage for what we are about to unpack. We're going to look at companies that absolutely crush their expectations, only to deliver a jarring, head-scratching twist right alongside that good news.
Here is our roadmap for today. Section 1. Fintech's trade deadline day. Section 2, Chime, profit meets sudden exit. Section 3, Circle faces new rivals. Section 4, Block, layoffs lead to profit. And finally, Section 5, the big fintech takeaways.
All right, Part 1, Fintech's trade deadline day, moving numbers and desks. Moving right into Part 2, Chime, profit meets sudden exit, crushing Q2 and bailing out.
Let's start with Chime. They've spent the last year aggressively trying to prove they are way more than just a debit card with a sleek app attached to it. And while their Q2 performance completely blew past their own guidance, revenue hit $670 million. That's up 27% year over year. But here's the real kicker. Their earnings per share, which is a key metric indicating a company's baseline profitability, came in at 7 cents. Wall Street was expecting exactly 0. So we're talking about a real standardized GAAP profit. To put that into perspective, they lost over $7 a share this exact time last year. Management even raised their full-year revenue guidance way beyond the Wall Street consensus.
So what's driving those incredible financials? Well, it comes down to this key metric, 10.4 million. That is Chime's active member count, which just jumped a massive 20%. And it's not just that they have more members, they are actually making more money from them. The average revenue per member climbed 6% to $260. Our sources point out that Chime Prime and their over 75K income cohort are really doing the heavy lifting here.
But hold on, because here comes the unexpected curveball. Buried in that exact same press release, right alongside all of those incredible record-breaking numbers, is the news that their chief financial officer, Matt Newcomb, is suddenly stepping down. He'd been there for a decade. He literally just helped take the company public in June of 2025. Now, President Mark Troughton is stepping in as interim CFO. So the crucial point here is trying to understand the why. There's absolutely no scandal cited, no messy financial restatement required. It's just a sudden exit right when the fundamentals are honestly the strongest they've ever been. As our source perfectly put it, it's the financial equivalent of leaving the party right after you won the raffle. You can bet analysts are going to be hyper-focused on picking apart the timing of this exit over the coming weeks.
Okay, let's pivot to Section 3, Circle faces new rivals. Growth sputters as competition arrives.
Now, Circle's Q2 performance is fascinating because it presents a really stark contradiction. Check this out. While their USDC circulation grew a really impressive 19% to $73.3 billion, their actual on-chain transaction volume basically fell off a cliff. It dropped from $21.5 trillion in Q1 down to just $14.8 trillion. So you have more supply out there, but significantly fewer transactions. That is a serious deceleration for the issuer of the world's second largest stablecoin. And yeah, that translates directly to their bottom line. Total revenue and reserve income landed at $701 million, meaning their revenue growth cratered to just 7%. That is a steep drop from the 20% growth they were seeing just 1 quarter ago.
But hey, it's not all doom and gloom. While the growth engine might be sputtering a bit, Circle's regulatory moat just got significantly wider. During the quarter, the OCC actually approved their federal trust bank charter, which allows them to manage USDC reserves directly. This is a huge regulatory win, and it sets them up perfectly for the September 16th mainnet launch of Arc, their enterprise blockchain. And they're definitely bringing heavy hitters to the table. Validators for Arc include major financial institutions like BlackRock, MasterCard, and Visa.
Despite beating expectations and scoring those massive regulatory wins, the market reaction was pretty brutal. The stock initially popped pre-market before reversing into a loss of over 3%. It's like the market watched an incredibly hyped movie trailer and then absolutely hated the actual film. The reason? The looming threat of OpenUSD. It's a rival stablecoin that launched in June, it's heavily backed by Visa and Coinbase, and it's already grabbing real market share. Sure, Circle counters by pointing out they still processed roughly 70% of June's stablecoin volume, but make no mistake, the market is completely spooked by the new competition showing up at the gate.
And this brings us to a really fascinating historical parallel. You can think of this as Circle's Blockbuster versus Netflix moment. But there's a critical difference here. Circle, the incumbent in this scenario, actually saw the streaming wars coming. They've built the regulatory moat, they have the reserves all stacked up, but they still actually have to get down in the trenches and fight against these well-funded new competitors. As we're seeing, having the advantage doesn't mean you automatically win the war.
Let's move on to Section 4. Block. Layoffs lead to profit. Radically restructuring for a massive beat. Now, this is a prime example of a dramatic corporate pivot. Back in February, Block announced one of the largest staff reductions in the entire S&P 500, cutting more than 40% of their staff. It was massive. But management didn't frame this as a desperate retreat. No, they framed it as an aggressive, AI-driven bet on the future of their product development. And guess what? The first full quarter proof point of that brutal workforce plan is officially in, and it resulted in $3.17 billion in gross profit. That's up 25% year over year, completely exceeding their own prior guidance.
To really grasp how they managed to pull that off with 40% fewer people, you have to look at this staggering number, 130. That is the number of brand new product features Block shipped in just the first half of the year alone. To put that into perspective, they shipped just 40 features in that exact same period last year. So they literally more than tripled their product output with nearly half the staff, leaning heavily into that AI-driven strategy they've been championing.
And all that productivity translates to a beautifully green scoreboard. Adjusted EPS came in at $1.02, cruising right past the 87-cent estimate. Revenue hit $6.62 billion. Cash App's gross profit shot up 31%, with consumer lending origination volume absolutely exploding by 59%. Even Square's U.S. gross payment volume accelerated to its fastest pace since Q2 of 2023. Block even confidently raised their full-year guidance for the second straight quarter. Going back to our sports analogy from the start, this is literally the fintech version of a team blowing up its entire roster at the trade deadline and immediately making the playoffs. They turned a highly risky, fewer people, more product bet into a repeatable formula.
Which brings us to Section 5, the big fintech takeaways, making sense of the chaos. So what should we take away from all this? The numbers clearly show that in today's landscape, a perfect earnings sheet is almost never just a simple success story. It practically always comes with a major catch, a looming rival, or a totally brutal backstory. For Chime, we learned that a historic beat and raise quarter absolutely doesn't guarantee a stable C-suite. For Circle, we saw that even the absolute biggest incumbents with the widest regulatory moats aren't immune to slowing growth when highly backed new competition arrives. And for Block, we saw hard proof that a seemingly reckless, brutal corporate restructuring can actually lead directly to the best financial quarter the company has seen in years. As you process all this wild data and the shifting landscapes we just mapped out together, I want to leave you with one final thought about the extreme lengths these companies will go to in order to win. Seriously, look at what it took to generate these earnings reports. Are extreme corporate strategies, like a CFO bailing exactly at the peak of a company's success, or a tech giant firing nearly half its staff just to multiply its product output, are these becoming the unavoidable new normal required for true dominance in the tech and finance sectors? It's a question every single investor and user should be asking themselves right now. Thanks so much for joining me on this explainer.